was to connect the dots. Typically, the only thing I didn't understand as a new trader was I would start my trend line here and try to guide it up, and that's where I would fuck up. Because just because this is a low and this is a low and this is a low doesn't mean I have to start at the first initial low. I have to try to make it fit in a line as best as possible, because as many times as it touches a certain level, like here, 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 and here, is not perfect, but it's situational, it's conditional. But a break of this here, okay, this is a descending wedge, and what does this look like? And then we got a
Mhm.
break of structure saying the uptrend is now changing into a downtrend. So any ascending wedge, a potential, from a high point, is going to give you a reason to sell off. So every single ascending wedge at some point is the highest point that market, has been, and is going to potentially, depending on the time frame, sell from that high. That's the same approach that I take to these account flips, but I'm using the market's rules against each other. I personally won't consider buying this until we break over this descending wedge on the higher time frame, just like we did this ascending wedge on the higher time frame, because the time frame's importance is the same consistently. But in this case, in scenario, until we break over this level of structure, I'm more likely to be in a downtrend because these higher time frames run the entire market until we completely cross over. And it's like if they stop in the storm, it's going to be a series of lower lows and lower highs. So when I compound and I'm matching the time frames, I know the rules of an uptrend, I know the rules of a downtrend. That doesn't change. But the market works the same way.